Hello and welcome to this week's technical analysis review here at XM.com. It's Monday, March 18th. I'm Christina Bartonidu, investment analyst, and the pairs we're going to look at today are pound dollar, euro yen, and WTI oil futures. So starting with pound dollar, we can see that the price had a strong rebound last week to recover previous losses, but the 1.33 key level appeared unbreakable once again. This is the fourth time since June. Technically, we could say that the next move in the market could be positive to neutral in the short term, because if you look at the MACD, the indicator continues to increase positive momentum above its red signal line, while the RSI seems to be reversing towards its 15 neutral mark. If we see downside corrections below 1.33, immediate support could come between 1.3220 and 1.3150, and then down at 1.3080. Lower, steeper sell-off could start below 1.30 and, more importantly, under the 200-day moving average, currently at 1.2980. Otherwise, if the market improves above 1.33, the previous high of 1.3380 could provide some resistance before the focus shifts up to 1.3460 and 1.3548, an important restrictive area over the past 3 days. In the medium-term picture now, the outlook is still positive given the higher highs and higher lows over the past 3 months. The golden cross between the 50 and the 200-day moving average lines could be a signal that this uptrend may last for longer. Moving next to euro-yen, the market closed positive last week and above the 50% Fibonacci of the downleg from 1.3321 to 1.1857. Therefore, confidence is likely to appear stronger in coming sessions. The RSI has surpassed its strong resistance around 56 and is currently pointing up, while the MACD is stretching above its red signal line. So this is another positive indication that further improvement could follow up, in which case we should keep a close eye on the previous peak of 127.49 and then and the 200-day moving average at 128, because any decent rally above this area may turn the market even stronger, with the price probably heading up to meet resistance between 129.30 and 130. In the alternative scenario, the pair could drop back below the 50% Fibonacci of 125.80 to retest support between 124.13 and 123.75. Even lower, 122.38 and 122 could be another challenge, as any downside below those levels would activate this bearish downtrend, turning the medium-term outlook from neutral to bearish. Finally, looking at WTI oil futures, which have been also progressive last week, we see that the market action has been taking place around the upper Bollinger Band over the past 3 days, so downside corrections are very likely. The fast stochastics support this view, as well as the red percentage D line and the blue percentage key line have already crossed each other in overbought territory above 80 and are heading down, signaling overbought conditions. The RSI down here has slowed down just below 70, but as long as it holds above 50, any weakness could be under control. A decline could stop near 57.72, a restrictive area from February onwards. Moving further down, 55.60, which is the 38.2% Fibonacci of the downleg from 76.87 to 42.53, and a frequently tested area could be the next target, while lower 54.54 could be another potential support to look at. On the upside now, we should wait for a rally above the 50% Fibonacci of 59.70 before increasing buying orders towards the 200-day moving average, currently at 61.80. Beyond this line, the medium-term outlook would turn even positive, and resistance could run even higher, up to 64.40. So that's all from me. Thank you for watching and have a great day.